We shall be talking about the indicators of monetary policy, the repo rate, reverse repo rate, CRR, SLR, and Msfr. When we say the monetary policy, the flow of the money in the country, it should be optimal. It should neither be less nor more. If the flow of money is too high, that means the people have excess money supply in their hand, which means that commercial banks are very legitimately giving loan to the people. That is why they have so much of excess money supply. What will happen is they will buy more products. When their buying will be more, this means the demand will increase. The increased demand will lead to increased price in the country, which will lead to a situation of inflation. On the contrary, if commercial banks is giving a very tight credit monetary policy, it is not easily giving loans to the people, then what will happen? People will have comparatively lesser money in hand. They will be buying less products. The demand will be decreased because people are not buying the items. This will lead to fall in the prices, and what will happen? There will be a deflation situation in the economy. Now, the inflation situation is not good for the country. The deflation situation is also not good for the country. Now, to tackle these types of situation, that means to create equilibrium, optimalism in the country, the government steps in. The way government controls the supply of money, that is to create price stability. It has to create trust in the value of currency. The value of rupee in comparison to dollar, it should be stable. Only then there will be trust created in the eyes of the people. So the government will be using these key factors to maintain this equilibrium in the country, which include the repo rate, reverse repo rate, CRR, SLR. We shall be discussing all them one by one. First, we shall talk about repo rate and the reverse repo rate. Repo rate. When commercial banks need money, sometimes commercial banks have shortage of cash. They need money for short-term duration, maximum 1 year. What will it do? It will take loan from the central bank. When people, you and me, we want more money, we want cash, we take loan from the commercial bank. And when commercial bank wants more money, it takes loan from the central bank. Commercial bank has to keep some asset, some security, some collateral deposit with the central bank. It will keep its collateral and then central bank will issue its loan. Central bank will also charge some interest from the commercial bank. This interest is called the repo rate. Central bank will be charging because commercial bank is taking loan. It has to pay certain amount of interest, which is called repo rate. So it is a very simple figure. Now when the commercial bank will return the borrowed money with interest to the central bank, then commercial bank will take back its collateral deposit, which initially it had deposited with the central bank. Commercial bank repurchases its collateral from the central bank. That is why repo rate is also called repurchase rate. Now comes reverse repo rate. When the central bank needs money, it can borrow from the commercial bank. In the previous slide, we discussed that commercial bank is taking loan from the central bank. But if sometimes maybe central bank also needs money, it is in need of cash, so it will take from the loan from commercial bank. Similarly, the central bank has to keep collateral. Can also be possible that commercial banks, they have excess cash. People have deposited money in the commercial bank and there are no loan takers in the public. Nobody is willing to take loan. So commercial bank will have excess cash. The commercial bank will lend this excess cash to central bank. Commercial banks also knows very well that the money will be safe if it is lending it to central bank. Now the rate which the commercial bank will charge from the central bank and the central bank will pay this interest to the commercial bank, it is called reverse repo rate. It is the opposite of repo rate. Repo rate is when commercial bank is borrowing money from the central bank, and reverse repo rate is when central bank is borrowing money from the commercial bank. Now comes the cash reserve ratio. See, you are well aware that commercial bank receives money from the general public. Whatever money is collected from the people, the whole amount commercial bank cannot be used to give as loan. Whatever money collection is there, the full amount exactly cannot be given as loan, and it cannot be invested by the commercial bank. If whole money which is deposited is given as loan by the commercial bank, then it will have no zero safe funds with it in case any financial crisis situation happens. Because whatever was collected, it is given away as loan or it is invested somewhere else. So now commercial bank is empty. So commercial bank, if it comes across any financial emergency, it has nothing with it. Therefore, RBI has made certain guidelines that per day's collection certain percentage has to be deposited with RBI. RBI says that every commercial bank has to keep some reserve with the RBI. You have to keep certain percentage of money collection. That reserve you have to deposit it with RBI, and the reserve has to be given to that reserve which the commercial bank will give, it will give to Reserve Bank of India. RBI will pay zero interest to the commercial bank for this. But if commercial bank comes in a crisis or emergency and needs money, then RBI will give this money in order to save commercial bank. The portion which the commercial bank will keep with the central bank is called the cash reserve ratio. It is almost 4%. So whatever deposit is coming to the commercial bank, the whole money cannot be given away as loan. The whole money cannot be deposited as investment. The portion has to be kept with RBI as a safe amount, cash reserve ratio. Next comes SLR, the statutory liquidity ratio. Statute means by law. So now RBI has given another guideline to commercial bank that commercial bank has to keep some reserve with themselves, not with RBI. This reserve has to be kept with the commercial bank themselves. Why? To maintain liquidity, so that commercial bank, they don't go out of liquidity. To maintain that liquidity, they have to keep certain reserves with themselves. How far? In the form of gold, in the form of cash, or in the form of government security. In all these types, it can be immediately converted to cash, so that there is enough of liquidity with the commercial bank. A fixed deposit of the total deposits or the total assets is decided by RBI. RBI will tell the commercial bank that this much percentage of your total deposit has to be kept as SLR, has to be kept as statutory liquidity ratio, which the commercial bank has to maintain with itself. It has not to give to RBI. In the case of cash reserve ratio, that reserve has to be given to RBI. But in the case of SLR, in the case of statutory liquidity ratio, this liquidity maintenance has to be kept with itself, with commercial banks itself. Now the amount which is left after maintaining CRR and SLR, that amount can be given as public loan, or the commercial banks can use it for investment purpose. For example, if the total net time deposit is with the commercial bank is 100 crore, the total time deposit and the fixed deposit is 100 crore with the commercial bank, and CRR is 4%, so 4 crore rupees the commercial bank will give to RBI in the form of cash reserve ratio, and RBI will not pay any interest to commercial bank. Next comes SLR. If the RBI says SLR has to be 18%, so 18 crore the commercial bank has to maintain as liquidity with itself. It can be in the form of gold, cash, or government securities, but they should be immediately convertible to cash to maintain the liquidity. Now how much net is left with the commercial bank? 100 crore minus 4 crore minus 18 crore, this gives you 78 crore. So now the banks can give loan of 78 crore to the general public. Whatever is left out of 100 crore, 78 crore will be given to the general public, and it can invest also 78 crore. Matlab it can give half loan and half investment, whatever ratio it wants to distribute this 78 crore. This is now the will of commercial bank, how to discretion of commercial bank, how to use this 78 crore. But according to RBI, this 78 crore is readily can be given as loan, or it can be readily invested anywhere where commercial banks want it correct. Next is the bank rate. Bank rate is just like repo rate. The only difference is repo rate is for short term. When the commercial bank wants loan from the central bank for short term, that is called repo rate. And when the commercial bank wants loan from central bank for a long term purpose, then what rate will it pay to the central bank? It will pay bank rate. So there is the only difference between repo rate and bank rate is repo rate is for short term and bank rate is for longer period of time. And but naturally the bank rate will be higher than the repo rate because the time duration is more. Therefore bank rate charging is more as compared to the repo rate charging. Next very important factor is marginal standing facility rate. Please listen very carefully. Okay, if commercial bank needs loan, we all know commercial banks needs money. It needs loan in this situation, but the problem is that it has nothing to keep as collateral. We already told you that whenever commercial bank will be taking a loan from the central bank, it has to keep certain asset as collateral. But now what is happening is that commercial bank needs loan, needs money, but it does not have any collateral. Then RBI has given an option to the commercial bank to use anything from liquidity reserve as collateral. See, we told you in SLR, in statutory liquidity ratio, that you have to keep certain amount in the government securities. That is the SLR quota. Okay. Now in this MSFR, the commercial bank, because it does not have any other collateral, so what collateral will it keep? It will pick up the securities which it had kept in the SLR quota. Statutory liquidity ratio के लिए what securities it had purchased to maintain SLR, it will pick those securities and keep as collateral. Bank will use SLR quota government securities to keep as collateral because it is an emergency situation where commercial bank, it has nothing to be kept as collateral. So what will it do? It will use SLR quota securities to raise more funds. For repo rate, banks will pledge non-SLR quota securities. Whatever is fixed for SLR, it will not touch those securities in repo rate. But in the emergency situation, when there is crisis, because they don't have anything to keep as collateral, so what will it do? It will use SLR quota securities because there is no non-SLR quota securities. So it will keep those SLR quota securities with the central bank and it will get loan. This MSFR is also called liquidity adjustment facility. Central bank charges interest from the commercial bank, which is called marginal standing facility rate. What will be the rate? The rate will be repo rate plus extra. 4% is the repo rate. It will be charging 4% plus 0.25, that is 4.25%. Because bank has, if the bank is having non-SLR quota securities to be kept as collateral, then it will pay the normal repo rate, which is 4%. But because the bank does not have non-SLR quota, it is using SLR quota securities. Therefore, you have to pay higher rate of interest. The commercial bank will be paying higher rate of interest, which is 4.25%. This is the penalty for the commercial bank because it is using SLR quota securities. Now the question is, what is the maximum loan amount a bank can take? It is 2% of NDTL under MSFR. Whenever it is going to acquire the loan under MSFR, it cannot exceed 2% of the NDTL. Now, marginal standing facility rate is a facility which a scheduled commercial bank can borrow additional amount of money from the central bank by dipping into SLR portfolio. Dipping into SLR portfolio means it is using SLR quota securities, but the limit is 2% of NDTL. This MSFR comes with a penalty rate of 0.25% extra to the repo rate. By doing this, by availing this facility, the money supply in the economy increases because the commercial bank will take loan and it will give it to the public. Therefore, when the money supply in the economy will rise, the demand will rise. MSFR, it acts as a liquidity injection in the economy. So here we come to the end of the article. I hope I have made the things very clear to you. In case you have any doubts, please feel free to ask me in the comment section. Kindly like, share, subscribe my channel. Thank you for watching. Stay safe, stay blessed.